today we're going to be covering market structure, the importance of it, why you need it in a solid trading strategy, and why it is one of the most important foundational skills that you can have throughout your journey. And the reason I wanted to start with market structure today is because nearly every strategy, whether it's supply and demand, support and resistance, liquidity sweeps, breakouts, all rely on being able to read the chart and correctly determine the trend to ultimately place your entry. So no matter where you are in your trading journey, it's always good to be improving on these foundational skills and furthering your knowledge. So today's video is going to be structured by covering the very basics at the beginning, followed by some live chart examples, and then some more advanced concepts towards the end. So if you are a complete beginner just getting into trading, this is the perfect video for you. However, if you are a little bit more intermediate or advanced, stick around because, as I said, there is going to be some more advanced concepts towards the end. So without wasting any more time, let's get straight into today's video. So if you are completely new to trading, market structure can seem a little bit daunting, but believe me, it's not. And to prove to you how simple it is, the market can really only be going in three ways directionally. And the first is an uptrend when the market is pushing up. Now this happens when there are more buys in the market and you'll be placing long positions. The second is consolidation, and that's when the market is going back and forth, forming a little bit of a range. This can happen for a few reasons, such as low volume, indecisiveness of traders, or when we are coming to a reversal. Now normally you would stray away from this and not be placing any positions unless you have a specific strategy that calls for ranging markets. And then lastly is the downtrend, when the market is obviously pushing down. This happens when there are a lot more sellers in the market and you'll be looking for short positions. So this is an uptrend with all the labels on. So I'm just going to walk through each of the moves and explain why they essentially happen. So in the beginning we have an impulse move. This is when the buyers obviously outweigh the sellers, forming an imbalance, pushing the market up, either starting or continuing the uptrend wherever you are in the market. This is then going to form a swing high, which is then ultimately followed by a pullback to balance out the market. Now a pullback can happen for a multitude of reasons, some of them being these buyers who entered in here may be taking some profits from the swing high. Some traders on the lower time frame may see this as a good opportunity to sell. However, nonetheless, we do have a pullback followed then by a swing low. Now, some buyers who are already in this impulse move may add to their position here, and also some traders who missed out on this previous impulse move see the market at a discount and then enter in right here. This is then going to form another impulse move, and this essentially repeats itself for the continuation of. This then causes another impulse move, and this essentially repeats itself for the continuation of the uptrend. So here we have the impulse move, which is now when sellers are outweighing the buyers. People will be taking some profits here, and then some buyers will also enter in that position, forming a pullback, which is then followed by a swing, which sellers will then re-enter the position, and other traders who previously missed out on this impulse move will then also enter in, and then essentially repeat itself with impulse move, swing low, pullback, swing high, and then again. So an easy way to remember an uptrend and a downtrend. On a downtrend, you are going to be having lower lows and lower highs, and then on an uptrend, you are going to be having higher lows as well as higher highs. Now, moving forward, that was obviously a basic form of an uptrend and a downtrend. However, uptrends don't consist of four straight lines just going up and down. So this is what an uptrend will closely more resemble on a live chart scenario. So this is a graph that I did draw up. However, this is when now I want to introduce major swing highs and lows as well as minor swing lows and highs. So here is the same graph. However, I have labeled all of the major swing highs and the major swing lows. So I'm just going to walk through each of the moves of the chart, and then I will explain how to actually identify and differentiate between the two. So just like before, we have the impulse move. This is going to form the highest point, which is the major swing high. And then over here, we did come down, forming a minor swing low, pushing a little bit back up, forming another minor swing high, and then ultimately finishing the pullback at the lowest point, forming the major swing low. Now the next impulse move went directly straight up, breaking the major swing high, continuing structure for an uptrend. We then repeated it just like last time, forming a minor swing low, minor swing high, and then a major swing low over here. And then that is essentially going to continue for the rest of the uptrend. Now, how to label this for yourself and spot the difference? Well, as I mentioned before, a major swing high is going to be the highest point of the impulse move, and a major swing low is going to be the lowest point of the pullback. Now, obviously, when you are in a downtrend, that is going to be reversed. It's going to be the lowest point of the impulse move and the highest point of the pullback. So as you can see, this major swing low is obviously the lowest point of this pullback. This major swing high is the highest point of this impulse move, and then so on and so forth, following for the entire trend. Now, the reason that this is important is because a lot of people, when they are beginning to learn market structure, they get caught up with every single little move and candlestick. So I know that when I was learning, if I were to see this minor swing low being broken by this move here, I would instantly think that we are now in a downtrend. However, that is not the case, and I'll explain why. An easy way to think of this is that if we were to mark up the major swing low to the most recent major swing high, all of the candles in between this doesn't necessarily make up structure. And what do I mean by that? Well, for example, let's say if we have formed up to here and all of this price action hasn't formed yet. Within this range from this major swing low and this major swing high, all of the structure in between this isn't going to impact the trend. Meaning, even if we were to break this minor swing low with this push down here, because it's not a major swing, we are still in the current trend. So then once we see price break this major swing high here, this is just going to validate the uptrend even more, continuing to the upside. So hopefully that does make a little bit of sense. If you do need to replay the previous sections, feel free to do so, because we are now moving on to some live chart examples. So this is an example of an uptrend on gold on 4-hour chart. Now the highlighted box is when the uptrend. Now this is a pretty clear uptrend and should be fairly easy to actually determine. So if I were to go through and mark up all of the major swing highs and swing lows, you can clearly see an uptrend forming, making this a lot easier to actually identify. And the reason it is important to determine the majors is, like I said before, so we don't get faked out by this minor swing low being broken and us instantly thinking this is a downtrend and us looking for sells. But just as I did mention in the beginning, an uptrend is formed by high lows as well as being followed by higher highs. Now this is an example of a downtrend on US 30 on the 1-hour chart. Now just like before, if I were to mark up all of the major swing lows and swing highs, you can see just how clear the downtrend actually becomes. And this is a good example because if we were to highlight this box here, you could mistake this as some sort of consolidation or even think that a reversal could be forming. Now, on the lower time frames, this may definitely be considered consolidation. However, that doesn't actually determine the trend. So if we were to mark up the most previous swing high and the most previous swing low, as you can see, the first to be broken was the major swing low, indicating this is a continuation of a downtrend. We should still be looking for sells. So moving on to reversals now. Now it is super important to be able to correctly identify reversals, as it's going to allow you to get even more accurate entries as well as being avoided to be faked out less. So there's two main ways that a reversal can form and the layout of which it looks like. So I have both of the two examples here. Both of these examples begin in an uptrend and then reverse to a downtrend. So in this first example here, we're in a current uptrend forming high highs as well as higher lows. However, when we do have this pullback, as you can see, we break this major swing low, forming a lower low. Now this is called a break of structure, and this is a good indication of a reversal. Now the next pullback is obviously going to be lower than the previous high, giving us now our pattern of lower highs as well as lower lows forming our downtrend. Now the second example is essentially the same, us being in a current uptrend, high highs and high lows. However, when we do have our pullback followed by our next impulse move, we are unable to break the previous high. Now this doesn't mean that we are automatically now in a downtrend. However, it is a good indication that a reversal is coming. And then just like the previous example, our pullback does actually break major structure, giving us now a break of structure, as well as the pattern of lower highs and lower lows forming our downtrend. So here are the same two examples, just reversed, coming from a downtrend reversing to an uptrend. As you can see, we have lower lows and lower highs. However, this pullback does break this major high, giving us a break of structure, forming our uptrend. And then the same with this example, coming from a downtrend, being unable to break this previous low, forming a higher low, and then validating it by breaking this major high, giving us now our uptrend pattern. So now this is an example of USD CAD on the 1 hour chart. As you can see, we are in a fairly clear downtrend, forming lower lows as well as lower highs. However, when we do reach the end of the chart, we can see that this major swing low is unbroken by this next pullback. Now, once again, this could be a minor swing low. We're not too sure yet, and it is only validated once we see a major break of structure to the upside. And as you can see, price is very easily able to break this, indicating that we're now in a valid uptrend. And if we do fast forward, you can just see how clear and strong this uptrend was, breaking multiple major swing highs, giving us our uptrend. Now, this next trend is an example of GU on the 1 hour chart. Now, just like before, if I do mark up all of the major swings, you can clearly see that we are in an uptrend. Now, obviously, for a reversal, we are going to need to see either a lower high or a break of structure for a major swing low. So this is the most previous swing low. So once we see a break of this, if it does break, it will indicate we are in a downtrend. So I'm going to mark up the most recent major swing low. So now, as you can see, price does come down and actually break this swing low, giving us an indication that we are now in a downtrend. And just like before, this downtrend is validated, giving us now the pattern as well of lower lows as well as lower highs. So hopefully everything is making sense so far. If not, feel free to go back in the video, rewatch whatever you need to before progressing further. But the next topic that I do want to cover is utilizing the higher time frame. Now, whether you're scalping or swing trading, I personally do believe that traders should be utilizing at a minimum 3 time frames. Now, me personally, the 5-minute is my entry time frame, so I do utilize the 15-minute for my zones, and then utilizing the 1 hour for determining extra zones and direction. And I will show you why this is super important. So this is an example of GU on the 1 hour chart once again. And as you can see, we are in a very clear uptrend, forming lower lows as well as lower highs. There's no doubt that this is an uptrend. However, if I were to mark up this pullback here, which is only about 15 to 20 candles, on the 5-minute chart, this is represented as over 200 candles. And what I mean by that is that if we were to go on the 5-minute chart, go back to our highlighted box. If we were to have jumped on a trading session without looking at any other time frames, we would think that this is a valid downtrend. And honestly, on the 5-minute, it essentially is. We are forming lower lows as well as lower highs, and we have even broken this major swing low, giving us a valid downtrend. However, since we have looked at the 1 hour, we know that we are in an uptrend, and this is just a pullback without breaking any major swing lows. And the reason this is important is to avoid having false entries being reversed on, and also allowing you to gain bigger risk to rewards. Now, don't get me wrong, by all means, if you were to take a random short position here, you are very easily able to get a 1-to-1, maybe even a 1-to-2, which is plenty if you are day trading. However, if we do look at the higher time frame, understand that we are in actually an uptrend, and then simply wait for a reversal with this swing high being broken as well as this swing low being higher. If we were to take a long position here, for example, placing our stop loss underneath this low, you can see that we are now able to actually catch the real move, being in time with the higher time frame, allowing us to get an even bigger risk to reward. So that is why it is very important to make sure to check the higher time frames as well as mark up any major swing highs or swing lows to understand where you are in the actual trend. Now, once again, you are able to take counter trend trades. However, if you are in the beginning stages and you do want to avoid being faked out and being used as liquidity, I would highly recommend trading with a higher time frame to once again allow you to avoid being faked out, as well as gaining a bigger risk to reward to achieve profitability a lot faster. Also, something to touch on, you don't have to only use just 3 time frames. Me personally, I also do look at the 4-hour chart just to gain a better understanding. Now, even though I do this briefly, it is also good just to see where we are on other charts, if we do have any reactions, and just how the candle is actually forming. Now, the last thing that I do want to touch on very briefly is fair value gaps. Now, I'm not going to go into a whole lot of detail simply because this does fall under more so price action than it does market structure. However, it does influence price as well as the trend. So I think it's best to at least introduce it now. So if you are watching, you are somewhat aware of it moving forward. Now, essentially, gaps are areas in the market that have not been filled in by price action yet. Now, gaps are always being formed in the market, whether they're big or small. So I'll go through this example of how to identify a gap and how it also influences market structure. So if we were to go back to when this candle was formed, so this candle here did push down a lot of the result from news, and this obviously formed a very large gap. Now, as I said before, gaps are areas where there are no price action. So if we were to mark up from the bottom of this wick to the lowest of the body, this is where the current valid gap is. Now, if we were to move to the next candle, as you can see, this obviously pushed up a little bit, filling our area in. So the new gap is now from the bottom of this previous wick to the highest point of the most current wick. Now, moving forward a little bit more, as you can see, this gap is becoming smaller and smaller, and this will eventually need to be filled in to essentially balance out the market. Now, gaps can either be filled in fairly quickly like this one is doing, or it can take a few days or even a few weeks. However, they will eventually be filled in. So if we were to move forward, as you can see, we pushed down a little bit before we did actually come back up and fill in the gap just like that, removing it entirely. Now, as I said before, gaps are always being formed in the market. They can be fairly big like that, or fairly small. So for example, if I were to zoom in on this little move here, this candle did push up a fair bit, forming us a very small gap from the bottom of these wicks to the highest point of the last bullish wick. Now, if I zoom in again, as you can see, we have a clear area where there is no price action. So this will eventually need to be filled in. So if we fast forward, this is filled in fairly quickly, eliminating the gap, giving us our price action. Now, gaps are super important because they do serve as a point of interest, which is good to determine if you are going to be placing either a take profit or a stop loss. So I would recommend it before you start trading. Identify if there are any major or large gaps on the chart where price could eventually be attracted to. So how does this influence and affect market structure? Well, if we were to go back to this candle here, now as you can see, we have broken some major swing lows, giving us a downtrend. However, something also to point out is that we do have this major gap that will eventually need to be filled in. So when price does decide to come up and actually fill this gap in, it does so. However, it also breaks this major swing high, causing some people to think that we are now in an uptrend. However, because we have actually marked up this gap, we know that we are simply just filling in this gap. And we also see the price rejected this beautifully, and we actually do continue to push down to the downside, allowing us to look for actual sells, allowing why the market is rejecting what it's doing, and avoiding us for being faked out in the market. So hopefully you guys did enjoy today's video and was able to actually take away something from it. If it did help you in any way, or you do have any further questions, feel free to leave a comment and I'll get back to you as soon as possible. Also, if you guys do have any future videos that you would like to see covered, also leave a comment on that. Make sure to like, share and subscribe. Show support for the very first video, and I will see you guys in the next video.